Hi, this is Rowland from Money Markets TV. With all the uncertainty in the stock market and the economy these days, many investors may be tempted to park all their money in bonds instead. Your return may be minimal, but at least you're safe, right? Not necessarily. Bonds and bond ETFs can be risky too. However, we do have ways to measure various types of bond risk. One way, of course, is credit risk, the quality of the debt issuer. But today, I want to look at another measure, interest rate sensitivity risk. When discussing this concept, you first have to understand a basic principle. Risk increases along with time. The probability of any event occurring, whether good or bad, will grow the longer you wait. With that in mind, let's talk about maturity. In financial terminology, maturity is the amount of time it will take for your bond investment to be completely repaid with interest. A 10-year Treasury bond's maturity is 10 years. As time passes, maturity gets smaller. A year after it's issued, your 10-year bond will have a maturity of 9 years. It gets a little more complicated when dealing with bond ETFs. They contain hundreds or even thousands of different bond issues. So you measure risk by looking at average maturity. But I use another yardstick when comparing bond ETFs, and I believe it helps measure risk even better. It's called duration. Duration measures the percentage loss a portfolio will sustain if interest rates rise 1%. With interest rates at historically low levels, this is something all bond ETF investors need to understand. Take the iShares Barclays 7 to 10 year Treasury bond ETF, for example. Right now, it has a yield of about 3%, right in line with 10-year T-bills. Not bad when you can barely make anything in a savings account. But IEF has a duration of 7.3 years, meaning it will drop 7.3% for each percentage point increase in the 10-year yield. Duration is a handy tool because it helps you know what to expect. You can then narrow down your buying list to ETFs that match your risk tolerance. I want to spotlight 7 popular Treasury ETFs along with their yields and modified durations. They span the entire bond curve from the iShares Barclays Short-Term Treasury to the Vanguard Extended Duration Treasury ETF. I chose only U.S. Treasury funds so that issuer credit risk wouldn't be a variable. And you can more easily see how longer maturities mean increased risk. We can see that the relationship even more clearly by looking at this chart. If you buy the longest maturity ETF on the list, over the IEF example, you'll get an extra 1.7% in yield, but you're also taking on nearly 4 times as much interest rate sensitivity risk. And this can have a major impact in the real world because rates can climb quickly. In just 50 market days from last November to this February, the yield on 30-year Treasury bonds rose from 4.12% to 4.75%. The Vanguard Extended Duration Treasury ETF fell more than 14% during that time. Think about that before you buy a bond fund just because it has a higher yield. Of course, rising interest rates aren't the only potential problem when you buy a bond ETF. You have to consider credit risk, yield, and other factors as well. Duration is a tool that helps clarify your thinking. And to make it even better, it's free. So look for it and use it. I'm Rowland for Money and Markets TV. Thank you for watching.